You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. Dallas Fed President Lorie Logan has proposed shifting monetary policy away from the federal funds market, arguing that other money market rates are better targets in today's financial system. Although changes in Fed funds ripple into other short-term rates, daily trading volumes are now just 2% of the volume in repo markets. The Fed has changed the way it conducts policy several times throughout its history, and the process could be surprisingly quick. So if you've ever wondered what the difference is between all those short-term interest rate acronyms, you're in luck, because on today's episode, we talk with Bill Nelson, Chief Economist and Chief Research Officer at the Bank Policy Institute, about how monetary policy impacts financial conditions, the changing nature of the federal funds market, and potential ways to improve the Fed's short-term rate policy regime. Stay tuned. Coming up soon, our interview with Bill Nelson, but first, a quick market update. The advance release of Q4 GDP this morning showed the economy grew 1.4% in the final 3 months of 2025, well below consensus estimates closer to 3%. The government shutdown clearly depressed economic activity, since the growth in final sales to private domestic purchasers, which excludes government spending, inventories, and net exports, grew at a solid 2.4% rate. Core PCE prices rose 2.7% at an annualized rate, a slowdown from the 2.9% rate in the third quarter. The January jobs report showed payrolls grew 130,000 last month, and the unemployment rate fell to 4.3%. There were signs of weakness in the details, and the annual benchmark revision said payrolls grew only 15,000 per month in 2025. But Fed hawks will see the falling unemployment rate as reason to keep rates on hold for the foreseeable future. The January CPI showed another month of benign inflation, rising 0.2% headline and 0.3% in the core. Although disinflation skeptics may point to distortions from the shutdown, there were still no signs that inflation has gotten any worse in the past few months. The minutes from the Fed's January meeting were published this week, largely reiterating the FOMC's on-hold stance expressed at the press conference. One notable hawkish development was that several participants believed the policy statement should add language underscoring the possibility of a rate hike if inflation got worse. The bond market gave no discernible reaction to the release of the minutes. The Treasury market rallied on net through the last 2 weeks, though some of that was the result of a risk-off mood from a correction in AI-adjacent stocks. The 10-year Treasury yield reached 4.02% for the first time in months, before inching closer to 4.08% by the time of recording. Fed funds futures have shifted between the June and July meetings for the next rate cut, but have consistently priced in between 2 and 3 cuts by the end of this year. That's all for the market update this time. Now our interview with Bill Nelson. Our guest today is Bill Nelson, Chief Economist and Chief Research Officer at the Bank Policy Institute. Bill, thanks for coming on the podcast.
Thanks for having me, Will.
Our topic today is the federal funds rate, how it drives financial markets, and what the impacts could be from possible alternative approaches to monetary policy. Bill, there's this shorthand that's always used, the Fed cuts rates or the Fed hikes rates. But what the Federal Open Market Committee directly controls is the federal funds rate. And it's not even a rate, it's a target range. So to start things out, what is the federal funds market, and how does the Fed make sure the rate stays within its target range?
I'd start by saying the FOMC doesn't even control the Fed funds rate. It seeks to influence it, and then influences it pretty well. But what the FOMC and the board control are the Fed's balance sheet and the interest rates that they pay on loans that they make and on deposits that they receive or reverse repos that they receive. And what they do is they adjust the size of their balance sheet so that reserve balances, which are one of their main liabilities and the one that moves around at the margin, are equal to a level which, when combined with their lending and borrowing rates, leads the Fed funds rate to be in that target range. That's how they do it. And the Fed funds market is not, despite the word Fed in the name, it's a private market, just like any other private market.
So what is the effective funds rate? I mean, when we go to the New York Fed website, you can see that these transactions are not all at the same rate. So what is it when the effective funds rate is published?
The effective funds rate is a weighted median of the federal funds rates of the transaction rates. So it's effectively the middle transaction rate. Whereas the rates that actually happen, they can vary, they're higher or lower. Not that much higher or lower unless it's a very stressful, turbulent day, but they cover a range.
And how, I think you mentioned it earlier, the repo rates or the interest on reserves, but how does the Fed enforce the boundaries for this target range that, for as long as I can remember, has been 25 basis points? So these overnight lending between banks, how do they make sure that there's no lending happening below the lower bound or above the upper bound?
Well, they don't make sure of that, and transactions do very rarely happen above and below, but there are steps that they take to encourage the rates to stay within those upper and lower bounds. Basically, the lending rates that the Fed provides, the discount rate or the standing repo facility rate, serve as a ceiling on Fed funds transactions. Fed funds participants are generally banks. We'll discuss that in a minute, I think. And banks have access to the Fed's discount window. If another bank wants to lend the bank money at a rate above the discount rate, then the bank can say, well, actually, I don't need this. I'll just borrow from the Fed at the discount window instead. So that's why it acts as a ceiling. Now, banks don't like borrowing from the discount window, so the rate can get above that level, but that's the idea. Banks also deposit money at the Fed. Their deposits are called reserve balances, and they earn the interest on reserve balance rate on that. So conversely, if a bank sees the Fed funds rate trending below there, it will say, well, I don't want to lend money into the Fed funds market at a rate below what I can earn on by just leaving it here on deposit at the Fed. So the interest on reserve balances, or IORB rate, acts as a floor on the Fed funds rate.
I think that's helpful because those different rates incentivize it so that banks do not lend at anything below the lower bound or borrow above the upper bound. At least really set the scene so that they can keep it within the target range. Now, you said that banks are accessing the federal funds market. Who is that universe of people who have access to it? Can I borrow at the Fed funds rate?
So it's interesting. It's interesting to geeks like me, but a Fed funds transaction, only a bank can borrow. This all comes back to what is a deposit against which a bank has to hold a reserve and what isn't. So if you lend to a bank on an unsecured basis, that's a deposit. And the bank, if the reserve requirements were above zero, banks would have to hold that a reserve against it. But if a bank lends to a bank unsecured, typically overnight, that's a Fed funds transaction. And it's also important when you want to understand how the market is functioning today, that GSEs, including Fannie and Freddie, but the federal home loan banks, they also can lend on an unsecured basis to banks and have those classified as Fed funds transactions. I want to jump back to your previous question just to clarify something. The range that the FOMC sets for the Fed funds rate is not necessarily defined in the upper bound by the discount rate and in the lower bound by the IORB rate. The IORB rate, for example, is above that lower bound. So there's two separate things. There's the corridor established by the discount rate and the IORB rate, and then there's the 25 basis point range that the committee has set. And if you go back before the global financial crisis, they didn't set a range, they set a target. I actually think that was beneficial for them, and they would be well served to go back to a target because it provided a clearer signal for markets. Nevertheless, there's two things. There's that range, and then there's the upper and lower bound, the corridor, the monetary policy corridor, as it's called.
I think that's really helpful to know, and we're going to get into some of the history of how the Fed has approached monetary policy in just a bit. But I have a question about Fed funds futures contracts. So you bring up an interesting point that the definition of what is classified as a Fed funds transaction is a little blurry, and it really just might depend on the borrower and lender. They're a popular way to express market expectations for the path of Fed policy. Does that mean everyone who is dealing with these contracts is someone who eventually has the right to borrow at the Fed funds rate? I mean, when I have a futures contract for oil, it gives me the right to buy West Texas Intermediate at that price. But if I, as an individual, can't borrow at the Fed funds rate, do I have any business with a Fed funds future contract?
The two are distinct. I think that anybody can participate in the Fed funds futures market. And Fed funds futures, if I recall correctly, settle to the average of the effective federal funds rate over the month. And while the definition is a little bit hard to provide in simple terms, it is well defined. And so the universe of what is a Fed funds transaction is well defined, and that's what goes into the calculation of the effective Fed funds rate. It's just a little hard to summarize. The key thing is that it's an unsecured borrowing by a bank, where on the other side, it's generally banks and GSEs.
We've talked about how this market is a private market and not everyone can participate in it. So, can you walk us through the mechanisms that the Fed funds market channels into other short term funding markets? Because, of course, this is how the Fed is looking to fulfill its dual mandate of price stability and maximum employment. But if a lot of interest rates, a lot of borrowing rates in the economy only flow downstream from the Fed funds market, well, how is the Fed funds market influencing the rest of them?
One way is that the participants in the market can arbitrage between borrowing or lending in that market and borrowing and lending in other markets. So, for example, right now, the Fed funds market consists almost entirely of federal home loan banks lending to the branches and agencies of GSEs. And the branches and agencies of GSEs earn the IORB rate. The federal home loan banks in their deposits don't earn anything on their deposits at the Fed, but they do, for a variety of liquidity risk management and regulatory and other reasons, wish to have some Fed funds loans extended. So they lend to the U.S. branches of FBOs, and the two kind of agree on a Fed funds rate that's a bit below the IORB rate that the branch earns when they borrow, but above, and this is where I'm going to get into arbitrage, the repo rate that the federal home loan banks could alternatively get if they were to lend into the repo market. It's not perfect, and the repo rates are currently above that level, but that's sort of generally how it goes. So the higher is the repo rate alternative that the federal home loan banks can turn to, then the higher the federal funds rate they will demand in those transactions. So that's where there's sort of an arbitrage relationship, and the federal funds repo rates are big and are used in a lot of transactions. Banks also reference a lot of their lending to prime. Prime is not a market rate, it's a rate set by banks, and it's always set in reference to what used to be the target for the Fed funds rate, and now it's one part of the range of the Fed funds rate. It's a spread over that. But all those loans that are linked to prime move up and down with the FOMC's announced target. So all those mechanisms are ones through which the Fed funds rate translates directly. There's another, though, I think more important mechanism, which is when the Fed announces a rate, people take that as a signal of where they think rates are going to be, and they reprice to that rate. Sounds a little mysterious. I think I will always remember the first time I walked into the room with my colleagues where we were all determining the amount of reserve balances needed to set a new Fed funds rate or to target a new Fed funds rate, to achieve a new Fed funds rate. And lo and behold, the amount of reserves didn't change. The Fed announced the rate and rates just moved to that new level, and banks continued to need the reserve balances that they'd needed before. So that signaling mechanism is a very important one as well.
You talked about how the Fed used to target a rate rather than a range. So could you walk us through a brief history of how the Fed has conducted monetary policy in its century-plus history? Because if we're going to think about pros and cons of the effective regime and possible alternatives, I think it's important to know what else has been tried and why they've changed throughout time.
It's certainly been true back through the 70s that for the most part, except for a few years that were an exception, the Fed was basically targeting the federal funds rate. And that exception was during the period when Chairman Volcker was seeking to really break the back on inflation. And for a period of time, the Fed targeted the level of reserve balances or the borrowed amount from the discount window or the non-borrowed amount variously. But for the most part, the Fed has targeted a rate. And even as you go back in time, whereas the precise rate and the precise way of doing it varied over time, the Federal Reserve by and large was seeking to influence the rates that in money markets, or the rates at which banks borrowed and lent, in order to influence economic activity.
Got it. So it's been money market rates and how they get there has all changed. And I think something that's really interesting is how the amount of transparency in its communication has changed throughout time. So I believe that it was only as recently as the mid 90s that they started to formally publish their targets and announce policy decisions. Was that in an effort to be more transparent with the public, or does it go back to the guidance that you talked about, which is that if the Fed is going to prime markets for certain interest rate changes, it kind of does the work for them before interest rates are actually changed?
It is true that that shift took place much more recently than one would expect, but it used to be that the committee would decide on pretty much where they wanted rates to be. They would announce their instructions to the New York Fed was to seek conditions in money market rates that were more tighter or less, but they wouldn't announce a rate. And everyone sort of had to figure out what the rate was by looking at the transactions that the New York Fed was doing. Over time, though, the Fed did begin to announce the rate. And announcing the rate, I do think, is very beneficial because it helps with that signaling effort and it increases transparency. It's a very sort of interesting question as to, well, why didn't they announce the rate? I think it has to do with the longstanding belief that the Fed shouldn't engage in high-frequency transactions that Milton Friedman was a proponent of. But that view just really doesn't make sense these days. Even those people who want the Fed to follow a rule, they want them to follow a rule to achieve the interest rates that they're targeting. They want the rule to apply to the interest rates. So the Fed needs to conduct transactions in order for that to be the case. There was a belief that in order to be effective, monetary policy had to be somewhat mysterious. Could also tap into what was the rational expectations branch of macroeconomics, which basically concluded that monetary policy didn't matter at all unless it was a surprise. So it was kind of a misguided approach to be surprising. I'm not really sure exactly what the precise source of it is. And I don't know if there is a precise source, but you're right. The announcement of a target is not that far in the past. I would have put it farther back than the mid-90s, but you could be right.
We know there are other money market rates than the Fed funds market that you mentioned, and a really big market for it right now is SOFR. So can you tell us what the difference is between the Fed funds market and SOFR? Is it just the universe of borrowers and lenders is bigger, or are there different conditions? How should we think about the difference between the Fed funds market and the SOFR market?
I wouldn't think of the issue, you used this term before, and I don't really think of sort of the Fed funds market as somehow being exclusionary. It really comes down to what is a Fed funds transaction, and that's just defined in Reg D. And so effectively, it's a Fed funds transaction if a bank is borrowing unsecured, and then there's these other definitions. SOFR, like the effective Fed funds rate, is actually a reference rate. It's not a transaction or an instrument or a market. SOFR is the secured overnight financing rate. It's like the Fed funds rate, only it's based on repo transactions. And repo transactions take a variety of forms. They're often transactions between money markets and primary dealers, or between primary dealers and hedge funds, or between primary dealers. Each of those transactions can take a different form, but a repo is always two parties agree on day one to one party sells a security to another, and then at some date in the future, often the next day, that second party sells it back to the first party. And it sells it back at a slightly lower rate so that effectively the first party earns some interest on the loan. And this is primarily done with Treasury securities, followed by agency securities and agency mortgage-backed securities, and then at quite some distance, other securities. So if you think about you and I engaging in a Treasury repo, so I sell you a Treasury security today, let's say for $10 million, and I agree to buy it back from you tomorrow. I said lower, it's a little bit higher, for $10 million, $10 million, 100, 10,000 and 10,000 or something like that. You're lending money to me and I'm providing you collateral. And then when it's reversed, you're giving me my collateral back and I'm giving you your principal plus a little interest back. It's a very safe loan because if I don't pay you back, you can immediately turn around and sell that Treasury security. Legally, you don't have to wait for bankruptcy proceedings or anything like that. You can just immediately sell that security. That's what makes it a very attractive way for large, sophisticated money market participants to lend money to each other.
Typically, is a SOFR rate lower than Fed funds then because there is this collateral involved? It's not an unsecured loan?
Well, normally that's the case, but I don't believe it's the case now. In fact, I'm pretty sure it's not the case now. There's a variety of things that move around each market. And for repo transactions, for example, the scarcity or abundance of collateral can influence the market. The alternatives that are available can influence the market. The very peculiar nature of the Fed funds market these days has an influence on where the rate trades. So remember, the collateral doesn't necessarily determine the rate. So if you look at a business loan, often a collateralized loan is more expensive than an uncollateralized loan because the fact that the loan is uncollateralized tells you something about the creditworthiness of the borrower receiving the loan. So it isn't by itself a sufficient determinant.
That makes sense. It's just one of many variables involved in the transaction.
When I joined the Fed a long time ago, I was there from 93 to 2016. I asked, well, why aren't we paying more attention to this repo rate? It seems important. It's moving all over the place. And the answer was, just ignore the repo rate. It moves around for all kinds of crazy reasons that aren't relevant for economic activity, primarily having to do with the scarcity or lack of scarcity of the collateral underlying the rate.
Well, you might be alluding then to part of your answer for my next question, which is, so Dallas Fed President Lorie Logan, among others, late last year suggested the Fed should move away from how it currently conducts policy. The Fed funds framework that we've been talking about so far in this interview, why is she critical of the status quo? What does she see as the weaknesses of the current system?
The Fed funds market is effectively sort of a shadow of its former self. And that's because of the way the Fed is conducting monetary policy. It's conducting policy by overstuffing the banking system with a huge quantity of reserve balances, so much that the Fed funds rate ends up basically at, or in fact, a little below the interest rate that the Fed pays on reserve balances. That's called a floor system. One consequence of a floor system is that everyone has a tremendous amount of liquidity, and no one really has an incentive to lend into the Fed funds market because you can earn more, in fact, a little bit more, by just keeping the money on account. So right now, as I mentioned, the Fed funds market, it really just consists of these kind of arbitrage loans between Federal Home Loan banks and U.S. branches of foreign banks. And so there's a sense that it's just not that important of a market anymore. The repo market, by contrast, it's a $3 trillion market. That's the basis of a tremendous amount of monetary transactions, money market transactions. And so the argument goes, well, this is a more robust market. It's a more important market. We should be targeting the repo rate, perhaps SOFR, perhaps another measure of repo rates. The Fed can influence the Fed funds rate well. That rate is transmitted into other rates well, partly through that signaling effect I described, but also partly through arbitrage. But if you go back to the way the Fed used to conduct policy, it controlled basically supply and demand in that market by influencing reserve balances, by setting reserve requirements. And it was able to have a very tight control, very good control of the Fed funds rate with very little imprint on the market. It engaged in small transactions with primary dealers that weren't really important for those primary dealers as a source of funding. Primary dealers aren't even participants in the Fed funds market. So those transactions really just influenced this amount of reserves that were outstanding. And that influenced this other market at one reserve in which the Federal Reserve, except for the occasional discount window loan, really wasn't participating at all. By contrast, the Fed doesn't control the supply or demand of repo rates. It would have to try to control them by establishing things like its standing repo operations or its overnight RRP facility, which are standing facilities that basically provide reverse repos, which are loans, or repos, which are borrowings, from the counterparty's perspective, not from the Fed's perspective. And those sums could and have been vast over the past several years. So I think of it as a lot more like central banks' efforts to control exchange rates, efforts that sort of invariably fail. You know, if they try to keep those rates somewhere that the markets don't want them to be, they just get challenged and run on, and they have to engage in massive transactions. And either they fail or they end up with huge footprints in the financial markets. I think that it's much more prudent and it's much more consistent with the Fed having a back seat to the private sector for the Fed to target the Fed funds market. Now, another reason to be concerned about targeting the Fed funds market is the market right now is quite fragile. There are reasons having to do with the time of day that the transactions occur and the regulatory treatment of the transactions, why Federal Home Loan Banks do like to lend to the market at pretty much any rate, but not any rate. And the higher the repo rate is relative to the Fed funds rate, the stronger the incentive is for those Federal Home Loan Banks to just say, well, you know what, I'm just going to lend into the repo market. At that point, the federal funds market would effectively cease to exist. So that's not only a problem for the Fed. That's, of course, you alluded to the federal funds futures market earlier. That's a big market, and that settles to, and as does the OIS market, settles to the, some OIS transactions, that settles to the average Fed funds rate. And those transactions wouldn't have a rate to settle to. And that taps into the worries that were there for LIBOR, for example, in terms of its robustness, and the whole reason to move away from LIBOR to SOFR. So that's, I think, what's going on in the minds of the folks that are and as they've articulated, their reasons for encouraging the Fed to leave the Fed funds targeting and move to repo rate targeting.
Something that Lorie Logan also mentioned in a couple of her speeches late last year is that emphasis in the Fed funds market. What she said was the only major lenders in Fed funds are the 11 Federal Home Loan Banks. And she points out that after Silicon Valley Bank failed in the spring of 2023, and all of the banks in the financial system were tapping the FHLBs, the volume of the Fed funds market collapsed in March 2023, and so she sees that this fragility in the Fed funds market that you talked about means that monetary policy might not be as effective as we want in times of crisis. Do you think there's anything to that argument?
Well, it's a little bit like the inspector in Casablanca who was shocked to find that there was gambling going on. The federal funds market has deteriorated because the Federal Reserve is conducting monetary policy with this massive balance sheet approach, an approach that I'd note that the ECB, the Bank of England, the Bank of Canada, the Reserve Bank of Australia are all dropping now, having become more aware of the problems with that approach. And President Logan is a big supporter of the large balance sheet floor system approach to conducting monetary policy. It's completely possible to reinvigorate the federal funds market. It's happened before. The Fed was huge during World War II. That caused the Fed funds market to go away. But when they shrank, the Fed funds market came back. All the Fed needs to do is shrink. They need to reduce the quantity of reserve balances. They need to begin to conduct temporary open market operations. And they need to take some steps to get rid of the regulatory and supervisory bias towards banks holding reserve balances. But if they took all those steps, the Fed could become much smaller. The Fed funds market would revive. And they would be back to a situation where they would have a robust market, but nevertheless a modestly sized one that they could control well without having a big imprint in the markets. So I think that's the approach that they should take.
Something else that President Logan mentioned is something that you also talked about, which is that the daily trading volume of Fed funds was just over 100 billion last year. For SOFR, it was about 3 trillion, and then this broader set of repo markets was $4.5 trillion. And I think she is using as a sign of the limited relevance of the Fed funds market, right? $100 billion is a lot less than $4.5 trillion. But as we talked about before, if the changes in the Fed funds market do ripple out into the rest of the financial system, why does it matter where the starting point is as long as there are impacts? Does she think that targeting Fed funds makes monetary policy less effective, more volatile? I mean, what is wrong with just focusing on the Fed funds market?
There's a range of views on this point across the committee, and they've frequently discussed what they should target and concluded that it's perfectly fine to target the federal funds rate. And for the reasons that I've just articulated in terms of control while maintaining a small footprint, the Fed funds rate is a better one to target. And as you noted, it's well transmitted to other rates. And there's no particular evidence that it's not influencing other rates. Whereas historically, repo rates are very noisy, and that noise is irrelevant. It averages out, and it doesn't really get transmitted into longer-term rates. Now, that's true for noise in the Fed funds rate, too. What matters is sort of where people expect rates to be over time, and expectations have the property that they smooth out high-frequency volatility. So it's just not really that important as long as people don't lose confidence. And if you look at a graph of the Fed funds rate, because it's now this sort of agreed rate, it's actually rock solid. The volatility in the Fed funds market is basically zero. Now, that's an artifact of the fact that it's this very odd market now. It's not an artifact of, the tremendous job the Fed is doing implementing monetary policy. But nevertheless, it's not as if that rate is moving all over the place and is out of control.
Something that Logan has suggested as an alternative, I know you've mentioned different repo rates, but she mentions this term, the tri-party general collateral rate. Can you give us an idea of what this rate is?
The tri-party rate is the rate at which dealers lend to each other primarily. It's mostly an interdealer rate between loans, repo loans between primary dealers.
And again, if the Fed is going to switch to one of these alternatives that Logan or opponents of the current system want, how is it going to be different? So let's say they want to target the repo rates or the tri-party general collateral rate. What are their operations that effectively change these rates that's different than what we see now?
Well, that's a good question. As I noted, they really don't control supply and demand in the repo market. Most likely have to rely heavily on their standing facilities for participants in the repo market. So there's two of them. They used to call it the standing repo facility, but they concluded that the word facility contributed to the stigma associated with it. So they're now calling them standing repo operations, which are provided at a facility. And those operations are twice in the morning, the Fed offers repo loans, mostly to primary dealers. Banks can have access, but the participants are almost entirely primary dealers. The large broker dealers that are the Fed's main counterparties and are the counterparties in Treasury auctions at a rate which is equal to the discount rate. So that provides repo funding to the primary dealers. And in addition, they take funds at a facility called the overnight RRP facility, which is a place where institutions can lend money to the Fed in the form of a reverse repo. That facility is almost down to zero now. It's at less than one. The participants in that market have been money market mutual funds almost entirely. They're the big lenders into the market, not the interdealer market, obviously, but into the repo market. They have a lot of cash to invest. They need to invest it in things that are super safe and super liquid. And a big part of their investments are reverse repos. And if the rate gets very low, they will switch to the Fed and lend to the Fed at the ONRRP rate, which is currently, I think, 10 basis points below the IORB rate. Not certain. That facility, for example, in the years after COVID, particularly when the Fed reverted to a quite punitive capital treatment on the part of reserve balances a year after COVID hit, that facility grew tremendously, and it reached, if I remember correctly, $2 trillion. It was at a point 40% of the assets of money market mutual funds were loans to the Federal Reserve, which is exactly the kind of giant footprint in financial markets that Jay Powell, Dan Tarullo, Jeremy Stein on the FOMC were all worried about when the committee opened the overnight RRP facility. And it's part of why I really think that it would be unwise to target repo rates.
I want to end with a question about the process of the Fed changing either to some of the improvements that you mentioned earlier or to President Logan's suggestions, all of that. What would it take for the Fed to change the way that they currently conduct policy? Is this something that the FOMC might just do on their own at some given meeting later this year? Will it be in one of their 5-year framework reviews? Do we need Congress to change it? If people are thinking about the possibility of the Fed changing how it implements policy, what is the timeline and process they should look out for?
There's no change in the law needed for a change in the Fed's policy. It's all being conducted under the same sets of authorities. that are not legally established, many of which are established by regulation, but also just by practice. Usually when the committee makes a big decision, like changing the way it's going to conduct monetary policy, it does so with at least 3 meetings, maybe in this case more. So it will have a meeting devoted to discussing the issue, maybe another meeting devoted to discussing the issue. The second meeting could well be guided by questions from the staff about what the committee would like to see. And then once a decision had effectively been made, the new approach is announced at the third meeting. For example, when the Fed decided to officially adopt a floor system, which happened in January 2019, there were discussions about it at the November and December 2018 meeting that led to that final decision. The Fed moved from its pre-crisis means of conducting policy to its floor system in the fall of 2008. It had been sterilizing its emergency lending operations so that they weren't boosting reserve balances by allowing Treasury bills to pay off. And when they opened one of the facilities, the CPFF, it was just too big. They didn't have enough left to sterilize. So they had to let it pass through to larger reserve balances. And the Fed had just received the authority. The authority had been received earlier, but it was just turned on for them to pay interest on reserve balances so that it was possible for them to attempt to conduct policy by oversupplying reserves and just allowing the rate to move to the IORB rate. Now, actually, the rate fell right through that rate. That's another very long story. But for many years, then the Fed had the rate set at 0, so they didn't have to worry about it. It wasn't until later in the 2010s when the Fed began to lift the rate off from 0 that it moved really into conducting policy with a floor system. So that sort of happened by expediency in order to engage in QE and engage in emergency lending, which boosted their balance sheet in a way that didn't allow them to continue to conduct policy. One thing that I'd highlight here, because it's very interesting and could be very interesting in the upcoming year, say, is that this is a decision that really has to be made jointly between the FOMC, which is a separate legal entity, and the Board of Governors. Many of the members of the Board of Governors are on the FOMC, but the FOMC also consists of 4 rotating Reserve Bank presidents' positions, so they're 2 different bodies. The FOMC decides on balance sheet policy, and since the standing repo facility and the ONRRP facility are implemented through the Fed's open market authority, Section 14, those rates are actually also set by the committee. But the discount, the IORB rate, the interest on reserve balances rate, that's set by the board. And the discount rate, that's kind of a mix. There's actually 36 discount rates, each reserve bank having 3. But the main one is the discount rate, what people say. And those are each established by the boards of directors of the reserve banks, subject to the review and the determination of the board. The board interprets that legally as meaning the board gets to set the discount rate. But I bet that there are some legal authorities at the reserve banks that would disagree with that. But let's just stipulate that the board sets the discount rate. You now have the committee setting the balance sheet policy and the IORB rate and the standing repo facility rate, and the board setting the IORB rate and the discount rate. If the board and the FOMC disagree about where policies should be set, then you have a very interesting situation developing.
Yeah, I could see how those could come into conflict in some hypothetical scenario that I hope we don't have to confront, because it sounds like it would cause a lot of confusion in markets. One last question. I know I said that my previous question was the last, but what do you think the odds are of any changes happening over the next year or two? Or is there so much uncertainty with the composition of the FOMC up in the air? Is this something that people should expect has a decent chance of happening, or is it really a tail risk?
I hesitate to answer that, Will, because as you can probably tell, it's a little hard for me to separate what I want to happen from what I think will happen.
Sure.
People often talk about what's your Fed funds call, and the word call always has that sort of dual meaning. As you could probably tell, I'm a big believer that the Fed shouldn't be conducting with its giant balance sheet approach, but that should instead shrink and adopt a much lighter footprint on financial markets. They could never return to the way things were in 2008. It's a different world. but there are ways that they could get a lot smaller. Right now, from the Fed's public communications, they seem comfortable with their current approach, even though the rest of the major central banks around the world have moved away from it. It's really hard to say. Sometimes you hear rumblings about discussing. My optimism has led me several times in the past to think that something will happen. So I don't want to be led astray again. So I'll just say it's possible, but I really can't put odds on it.
I understand. Fair response. Bill Nelson, thanks for coming on the podcast.
Thanks for having me, Will.
That was Bill Nelson, Chief Economist and Chief Research Officer at the Bank Policy Institute. What stands out to me most about that conversation is how much the Fed's interest rate policy approach has changed through its history and how easily it could change in the future. There will probably be some aspects of Kevin Warsh's agenda that the rest of the FOMC is hesitant to implement, but there could be a surprising amount of support within the committee for tweaking the Fed's near-term rate policy, whether it be changing the Fed funds target range back to a single rate, reducing the balance sheet to strengthen the Fed funds market, or moving towards other money market rates entirely. Because such changes have not required an act of Congress or long-term policy review in the past, changes could be easier to implement than many expect. The Supreme Court has announced a decision day for today, February 20th. The justices may rule on the legality of the tariffs implemented last year using the IEEPA law, though any decision would come after we finish recording. The January PPI next Friday is the highlight during an otherwise quiet week for economic data. The components for air travel, financial services, and hospital services will be important inputs for the January PCE deflator when it is released March 13th. The following week, the ISMs and vehicle sales will provide the first glance at February economic activity before the all-important jobs report on Friday, March 6th. Decent January jobs growth and 2 straight months of a falling unemployment rate have reinforced the perspective of Fed officials who are comfortable keeping rates on hold until they see more inflation improvement. Several FOMC participants are scheduled to speak next week, and we expect more will pop up after any big data releases. The Fed's customary pre-meeting communications blackout starts the evening of March 6th, after the February employment report. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.